So as we've seen thus far in 2025, volatility is everywhere. And according to our grandparents and other financial advisors out there, that 60-40 portfolio has always just been the de facto norm for retirement. How have you constructed these ETFs so that the capital preservation is achieved while also delivering 4% or more in annual income? And how does the volatility of the Trump tariffs or China's DeepSeek or anything else that's coming down the corner impact the annual income of these ETFs?
All right, so great question. The 60-40 has been this concept that's been around forever. Man, did it fail in 2022. 2022, you had a year where both bonds and stocks were down double digits. Guess what? These strategies would not have been. And the reason is we're not using the traditional bonds in the income portfolio. We're using synthetic income from options writing and things like that, or we're going into unique sets of bonds. Like we have a fund in here. It's called Riser, RISR. It's got negative duration. So it was actually up quite a bit in 2022. We're also using diversification. So I have buy rights in there on gold miners. I have buy rights in there on Bitcoin. I have buy rights in there on oil. So we're trying to give people that exposure. The construction of the portfolio isn't this, let's own stocks and own bonds and hope that they both go down in the same year. No. Where you're buying a portfolio, we call it our do no harm, low volatility situation, right? So it's short-term bonds, it's merger arbitrage, it's things like that. That bucket doesn't have a huge yield. Let's call it 2 to 4%, right? And that represents a big chunk of our, call it dry powder. Then the rest of the portfolio, I make a very high yielding. I own that Riser ETF. I own a veterans bond ETF. It's a portfolio of loans to veterans. And it's got a great yield and it's got great credit quality because veterans pay their debts more often than the rest of us. So you take those two. I've always got dry powder for those bad years to buy the stuff when it's at a discount. And then I've got the high income on the other side. And all we do is rebalance back to our target. Our target is at least 4%. Right now, because of the opportunities that we see, we're yielding closer to 7 or 8. If I saw a lot of risk in the market, then I would pull back to the 4% target.